Have you ever felt like you need a financial navigator, maybe someone to just cut through the sheer volume of information coming out of the Indian economy?
hmm
Because truly, every month brings this wave of new regulations, shifting market dynamics, and significant policy changes. It can feel like a lot to keep up with.
It really can. Information overload is definitely a thing.
Welcome to the deep dive. Today, we're doing exactly that. We're navigating through all that noise to give you a crystal clear understanding. We're looking at the most significant recent developments across India's financial markets, its banking sector, and the broader economic landscape.
Yep.
And our insights are drawn from a pretty comprehensive stack of crucial updates, primarily from May 2025.
And our mission
Yeah.
really is to provide you with a concise yet deeply insightful understanding of what's truly driving these rapid changes.
Right.
We'll explore what they mean for the markets, for investors like you, and for the everyday citizen. By the end of this deep dive, our goal is for you to feel genuinely well-informed on these critical shifts.
Yeah, without feeling completely overwhelmed.
Exactly, without feeling overwhelmed by just the sheer volume of information out there.
You've hit on something important there. Because the sheer scale and, diversity of changes we're analyzing, I mean, everything from intricate SEBI regulations in capital markets to major macroeconomic indicators and impactful Social Security initiatives, it can be a bit of a daunting mountain of data.
It certainly can look that way.
So our approach here is to provide a structured way to digest all this. We want to transform that mountain into, actionable insights that truly resonate with you.
Makes sense. A clear path through it all.
All right, let's begin our deep dive then. We'll focus first on India's capital markets. Here, the Securities and Exchange Board of India, SEBI, has been exceptionally proactive.
They really have.
It's genuinely fascinating to observe how they're constantly sort of fine-tuning the rules of engagement for how capital flows and investments are made.
It's true. SEBI's recent actions clearly underscore a strategic push. It's towards greater transparency, more robust risk management, and overall enhanced efficiency across various market segments.
So covering quite a bit of ground.
Yeah, from the complex world of securitization right through to the intricate mechanics of derivatives. Their intent seems clear. Build an even more resilient and, frankly, trustworthy financial ecosystem.
And speaking of robust ecosystems, let's explore something that acts as a vital bridge, really, between two massive parts of the economy, pass-through certificates, or PTCs.
Ah, yes, PTCs.
Specifically focusing on the residential mortgage-backed securitization, or RMBS market. On May 5, 2025, India achieved quite a significant milestone by listing its very first mortgage-backed PTCs on the National Stock Exchange.
That was big news.
It feels like a truly foundational step, doesn't it?
It absolutely is foundational. These aren't just, ordinary certificates. They were meticulously structured by the National Housing Bank promoted RMBS Development Company, RDCL, they call it.
Right, RDCL.
And they're backed by a substantial pool of housing loans. These ones originated from LIC Housing Finance Limited.
Okay.
And just to give you a sense of scale, the initial issue amounted to a significant euro 1,000 crore.
Wow, okay. Big number.
It is. And it offered a coupon rate of 7.26% per annum. And it has a very long-term maturity, stretching out for nearly 2 decades, almost 20 years.
So, beyond the impressive numbers, why is this such a pivotal moment for the Indian economy? It seems to fundamentally link the housing finance market, where you get your home loan, with the much broader debt market where these large-scale, long-term investments are made. It's like connecting the dots in a really tangible way.
That's the crux of it, exactly. This linkage has profound implications. By creating a more accessible and crucially liquid market for these residential mortgage-backed securities, you unlock the potential for significantly boosting growth in housing finance.
Right, makes sense. More money flows in.
Exactly. And when housing finance expands, it naturally stimulates activity in the entire housing sector, and by extension, the broader infrastructure development that, supports it.
Okay.
And RDCL's role here is designed to be that of a commercially sustainable intermediary. Its core aim is to facilitate the growth of this, still nascent RMBS market in India.
Okay.
And critically, to create attractive investment avenues for those long-term institutional investors. Think about the massive funds like insurance companies, pension funds, provident funds.
They need stable, long-term places to put their money.
Precisely. They're constantly seeking stable long-term returns, and these PTCs offer just that. And RDCL itself, it has a substantial paid-up capital of 500 crore. That signals its serious commitment to sort of nurturing this space.
That paints a really clear picture of its importance. Now, staying within this realm of structured finance, SEBI has also introduced some brand new regulations. These are specifically for securitized debt instruments, or SDIs.
Oh, yes. The SDI rules, another big move.
What are some of the key details there? What new parameters has they set?
Well, the new regulations for SDIs are quite comprehensive. They really reflect SEBI's drive for, I'd say, greater discipline. For instance, they've set a minimum ticket size of 1 crore.
1 crore, okay.
Yeah, for both the issuance and the subsequent transfer of these instruments. And this applies universally to both RBI-regulated and unregulated originators.
Okay, so it's broad.
It is.
Yeah.
And if an SDI is linked to certain listed investments, its minimum amount is then tied to the largest single investment within that pool.
Interesting.
And when these products are offered publicly, the offer must now be open for a minimum of 2 days, but no longer than 10 days. And a really critical change. All SDIs are now required to be issued and transferred exclusively in dematerialized form.
DMAT only, pushing towards digital.
Exactly, moving towards greater digital transparency and, frankly, ease of trading.
That definitely pushes for standardization. What about the entities that actually create these instruments, the originators, as they're called? Are there new requirements for their experience, or maybe how they manage risk?
Absolutely. SEBI is emphasizing both experience and a shared stake in the outcome. Originators are now mandated to have at least 3 years of operating experience.
3 years minimum.
Yes. And more importantly, there's a crucial risk retention rule. You often hear it called skin in the game.
Right, skin in the game. So they have something to lose, too.
Precisely. Originators must retain a portion of the risk themselves. It's either 10% of the value, or it drops to 5% if the underlying loans are expected to be paid back within 2 years.
Okay, so an incentive for shorter term, potentially less risky loans, too?
Could be seen that way. It ensures their financial incentives are closely aligned with those of the investors, right? And there's also a minimum holding period for these originators before they can offload these risks. It's 3 months for loans with a tenor up to 2 years, and it goes up to 6 months for loans exceeding 2 years.
Okay, this next point seems quite significant. SEBI is introducing some new mechanisms, but also, crucially, prohibiting others. Can you explain this optional cleanup call? And maybe more importantly, why are they saying a definite no to resecuritization and synthetic securitization? What's the thinking behind blocking those?
Certainly. The optional cleanup call is, well, it's a practical feature. It allows originators to repurchase up to 10% of the original value of the underlying assets in the SDI.
Okay, so a way to manage the tail end.
Kind of, yes. It provides a degree of flexibility for managing the residual portfolio. Now, regarding the prohibitions, this is where SEBI is drawing a very clear line in the sand. Underlying assets for SEIs are now restricted. They're limited to categories like listed debt securities, accepted trade receivables, rental incomes, and equipment leases. Pretty defined categories.
Got it.
The prohibitions on resecuritization and synthetic securitization are really fundamental to SEBI's de-risking strategy here.
Can you quickly break those down? What are they?
Sure. Resecuritization basically means taking assets that have already been securitized, bundling them together, and creating a new second layer of securities, like a security built on other securities.
Okay, sounds complex.
It is. And synthetic securitization, that involves using financial agreements, like derivatives, to transfer the credit risk of assets without actually selling the assets themselves.
So the risk moves, but the asset doesn't.
Exactly. SEBI is banning these because, frankly, they add immense layers of complexity and, importantly, opacity to the financial system. It makes it incredibly difficult for investors to truly understand the underlying risks they're taking on.
Right, like those CDO squared things from the financial crisis.
Precisely the kind of complexity they want to avoid. This move is a clear signal. SEBI wants to simplify and make transparent what was previously very opaque. It's about enhancing investor confidence in these instruments and hopefully preventing a repeat of some of the structural complexities that contributed to past financial crises globally.
That really clarifies the intention. Simpler, safer, more transparent for everyone involved. Good stuff. Now, let's pivot to something that directly impacts every investor, big or small. The Investor Education and Protection Fund Authority, IEPFA,
Yes, IEPFA.
in collaboration with SEBI, recently held a strategic meeting. They're preparing for an initiative called Niveshak Shivir. What's the core purpose of this drive?
The Niveshak Shivir is essentially a nationwide outreach program. It has a very clear and practical objective to streamline and simplify the process for investors to reclaim their unclaimed dividends and shares.
Ah, the forgotten money.
Exactly. We're talking about money and assets that rightly belong to individuals, but, may have been forgotten or lost track of over the years. It's surprisingly common.
This raises an important question, doesn't it? How many of us might actually have forgotten about old investments, maybe a small dividend check from years ago or shares from a company we invested in long ago? This initiative directly aims to help you, the listener, doesn't it?
Absolutely. The fundamental idea is to enhance financial literacy, promote transparency within the system, and crucially, reduce reliance on intermediaries who might otherwise, complicate the reclamation process.
So making it easier to get your own money back.
Pretty much. To facilitate this, help desks are being established. They'll offer direct support from companies and their registrar and share transfer agents, names like Lincoln Time and KFin Technologies.
Okay.
For those holding shares in dematerialized form, the process involves contacting their company directly. For physical shareholders, they can verify their share status and claim what's due through a specific form IEPFA.
Right.
And here's a really helpful tool. IEPFA maintains an online search tool on its website. You can easily check if any shares or dividends belonging to you or maybe even relatives have been transferred to the fund.
That's fantastic. People should definitely check that out.
It's a great step towards making the financial system more user-friendly and ensuring that investors finally get what's rightfully theirs.
That's definitely good news for many. Changing gears slightly, SEBI has also mandated a cooling-off period for directors at market infrastructure institutions, or MIIs.
Yes, the MII governance rules.
This sounds like a crucial step to prevent potential conflicts of interest and, ensure fair play.
It is indeed a crucial measure. SEBI has amended two key regulations, the SECC regulations from 2018 and the Depositories and Participants regulations, also from 2018, to introduce this cooling-off period.
So what does it mean in practice?
Essentially, a non-independent director who has served on the board of a recognized MII, I think stock exchanges, clearing corporations, depositories, will now be subject to a mandatory cooling-off period.
Okay.
And they'll also need prior SEBI approval before they can be appointed to a competing institution. It's designed to prevent them from immediately taking potentially sensitive knowledge straight to a rival.
Makes sense. Is there any specific nuance to this rule, maybe for public interest directors?
Yes, there is a distinction for public interest directors. SEBI has clarified that such a director, after completing their term at one MII, can be appointed for another 3-year term in a different MII, like moving from an exchange to a depository, for instance.
Okay.
That's subject to SEBI's prior approval, of course. However, the cooling-off period does apply, specifically if they are being appointed as a public interest director in a competing MII. So moving between direct rivals is restricted.
Got it. The distinction is about direct competition.
Exactly. The overarching objective is unequivocally clear. Enhance governance standards at these critical MIIs and proactively prevent any conflicts of interest or, potential misuse of confidential information by directors who might otherwise jump ship immediately. It's about ensuring market integrity and a level playing field.
Moving to another strategic area, SEBI has released new guidelines for brokers operating within Gift City. This seems like a deliberate move to accelerate India's ambition of becoming a global financial hub, right?
That's absolutely correct. SEBI is now allowing stockbrokers to conduct securities, market-related activities in the International Financial Services Center, the IFSC, at Gift City, with greater operational flexibility.
How so? What's the new flexibility?
They can choose how they want to operate there. They can do it either through a separate business unit, an SBU, which is part of their existing stockbroking entity in India.
Okay, like a dedicated division.
Right. Or they can opt to set up or use a distinct subsidiary company just for Gift City operations. This is designed to offer them more adaptive business models, depending on their scale and strategy.
So it's about providing brokers more options to set up shop and grow there, but presumably without compromising regulatory oversight.
Precisely. While SEBI has granted brokers the discretion to choose their form of operation, it comes with clear stipulations. For instance, the net worth of the SBU must be completely segregated from the net worth of the stockbroker's main Indian securities market operations.
Ah, clear separation.
Yes, and maintaining separate accounts is mandatory to ensure this clear division. All operations undertaken by the SBU and Gift IFSC will remain squarely under the jurisdiction of the concerned regulatory authority there, which will issue specific guidelines on policy, eligibility, risk management, investor grievances, and so on.
Okay.
And interestingly, brokers who might have previously established full-fledged subsidiaries or maybe joint ventures for their securities activities in GIFT IFSC now have the option to dismantle those.
Oh, really?
Yes, and streamline their operations under an SBU instead, if they prefer. The overarching objective is genuinely to facilitate the growth of stockbrokers' activities in GIFT IFSC, offer this enhanced operational flexibility, actively reduce bureaucratic hurdles.
Makes sense. Cut the red tape.
Exactly. All of these measures contribute significantly to GIFT City's bold ambition of becoming a truly global financial center.
It sounds like a concerted push for efficiency and transparency across the board. Now, SEBI also recently mandated an electronic book provider mechanism for private debt placements. What exactly does this involve, and who does it apply to now?
This is another significant stride towards, well, digitalizing and modernizing the private debt market. SEBI has now mandated the use of an electronic book provider, or EBP, platform for all private placements of debt securities amounting to 20 crore and above.
20 crore, okay. And what is an EBP exactly?
An EBP is essentially a digital platform. It's provided by a recognized stock exchange, and it's designed specifically to facilitate the private placement of securities, making the process smoother and more transparent.
I seem to recall the previous threshold for this was much higher. That suggests a significant expansion, right? Has that changed, and what kind of instruments are now included?
You're right. The threshold has indeed changed. Previously, EBP was mandatory only for debt issues of 50 crore or more. Lowering that to 20 crore significantly expands its reach. It brings many more private placements under its purview, and the scope is also expanded beyond just traditional debt securities.
Oh, what else is covered?
It now includes non-convertible redeemable preference shares, or NCRPS municipal bonds, and even real estate investment trusts, REITs, and infrastructure investment trusts, INVITEs.
Okay, quite a broad range now.
Yes. This mandate now applies uniformly to single issues, shelf issues, where a company can raise funds through multiple offerings over a period, and subsequent issues within the same financial year.
Are there any instruments where using the EBP is voluntary? And can you shed some light on the concept of an anchor investor and how they factor into this process?
Yes, certain instruments can voluntarily choose to use the EBP platform. Things like securitized debt instruments, security receipts, commercial papers, CPs, certificates of deposit, CDs, small and medium REITs, SM REITs, and INVITEs.
Okay, and the anchor investor.
Right, the anchor investor. In this context, think of them as a strategic investor who commits to taking a significant portion of the investment before the issue formally opens.
Like a lead investor setting the tone.
Exactly. They act as a major stamp of approval, maybe a lighthouse guiding other investors. Their upfront commitment plays a crucial role in price discovery and provides stability and confidence to the entire offering.
Okay. Any rules around them?
Well, the new rule states that for bids received at the same cutoff price, allotments will now be made proportionately to all bidders. That ensures fairness in distribution. Issuers also have new requirements. Submit their placement memorandum and term sheet, the detailed documents, at least 2 working days before the issue opens.
Okay.
Or 3 working days if they are first-time EBP users. In principle, approval from the exchange must also be obtained before these timeframes. And the green shoe option, allowing the issuer to raise more if there's excess demand that can't exceed 5 times the base issue size. What's truly fascinating here, I think, is how this move profoundly enhances transparency and efficiency in the private debt market. It makes it a more attractive and streamlined space for a broader range of institutional investors.
And speaking of institutional investors, SEBI has extended the compliance timeline for granular disclosures related to offshore derivative instruments, or ODIs.
Yes, the ODI disclosure.
Yours isn't just about demanding more data, is it? It feels like a strategic move to sort of level the playing field and seal off potential regulatory loopholes.
You've hit the nail on the head there. SEBI had previously mandated more detailed disclosures from ODI subscribers, especially those with, concentrated holdings or very large investments in single Indian corporate groups. The initial deadline was May 17th, 2025.
Right.
But that has now been extended to November 17th, 2025. Gives them more time. These disclosure rules specifically apply to ODI subscribers who hold more than 50% of their equity ODI positions in a single Indian corporate group, or whose total equity positions in the Indian markets exceed a hefty 25,000 crore.
Okay, so targeting the big players. Here's where it truly gets interesting, though. Beyond just requiring more information, it seems SEBI is also directly prohibiting certain actions by foreign portfolio investors, FPIs, related to these ODIs. What are those prohibitions, and what's the broader intent behind them?
That's absolutely right. The core aim of these regulations is to bring ODI rules into closer alignment with those applicable to foreign portfolio investors. The goal is eliminating any potential for regulatory arbitrage, basically exploiting loopholes or differences in rules.
Right, playing the system.
Exactly. To achieve this, the circular explicitly prohibits FPIs from two key actions. First, they cannot issue ODIs that have derivatives as their underlying asset.
Okay, no derivatives backing ODIs.
Correct. And second, they are now prohibited from using derivatives to hedge their ODI positions in India.
No hedging ODIs locally with derivatives.
Right. This is a decisive move. It closes off potential avenues for excessive risk-taking, complex structures, or maybe transactions that could otherwise bypass direct regulatory scrutiny. It's all about creating a more robust and, importantly, equitable regulatory environment for all market participants, foreign or domestic.
Moving to something that impacts every investor with a financial account, SEBI has also introduced an investor charter specifically for KYC registration agencies, or KRAs. What's the primary purpose behind this, and how does it benefit the individual investor, like me or you listening?
The main purpose of this investor charter for KRAs is pretty straightforward. It's to significantly enhance investor awareness and protection. It clearly outlines the rights of investors and provides a streamlined process for grievance redressal if something goes wrong.
So making rights and processes clearer.
Exactly. Ultimately, it's about improving transparency in the whole identity verification process and simplifying how investors can submit their service requests. It empowers you, the investor, with clear information about your rights and, critically, how to navigate the system if you have an issue.
Good move. And on the alternative investment front, SEBI has relaxed some norms for Category 2 alternative investment funds, or AIFs. This suggests maybe more flexibility for these specialized funds to invest?
Precisely. SEBI has now permitted Category 2 AIFs to invest in listed debt securities, including those securitized debt instruments we talked about earlier,
Right.
even if those securities are rated A or below by a SEBI-registered credit rating agency.
Oh, okay, so slightly lower rated debt is now okay.
Yes. And importantly, while their primary mandate still remains investing in unlisted securities, as previously required, they now have this additional flexibility. They can invest either directly or via units of other AIFs.
So it gives them a much broader scope for their investment strategy execution.
Exactly. More tools in the toolbox.
So this is giving them more room to operate. But how does it fit into the broader regulatory context? Is it still about promoting sound investment practices?
It is, and it's connected to earlier changes in the listing obligation and disclosure requirement, or LODR regulations. If you recall, those changes, for example, had previously barred issuers with listed non-convertible debentures, NCDs, from issuing unlisted NCDs while any listed NCD was active.
Right, I remember that.
So, while Category 2 AIFs are primarily mandated to invest in unlisted securities, these new permissions offer them more avenues for diversification. But they still have to clearly reflect their investment strategies in their private placement memorandums, their PPM.
So transparency is still key.
Absolutely. This move offers greater flexibility for private equity and debt funds, allowing them to diversify their portfolios while maintaining essential regulatory oversight. Just a quick reminder for listeners, AIFs are funds that pool money from investors for various asset classes. Category 1 is typically venture capital, startups. Category 2 includes private equity and debt funds, mostly in unlisted companies or debt. And Category 3 is more like hedge funds, using complex strategies in public markets. They usually have high minimum investments, like 1 crore, and lock-in periods.
Got it. Thanks for that refresher. Now let's dive into something that impacts the very core of market activity. SEBI's new open interest metric and revised position limits in the futures and options market. This sounds like a pretty comprehensive structural overhaul.
Oh, it's an enormous change. It's being phased in from July through to December 2025, and it's designed to achieve several really critical objectives.
Like what?
Well, SEBI aims to significantly enhance overall risk control in the derivatives market. They want to minimize manipulation risks, reduce excessive concentration, particularly in index options, and even decrease the frequency of individual stocks entering those F&O ban periods.
Okay, so making the market safer and more stable.
In essence, yes. It's about making the F&O market more robust and less susceptible to extreme volatility or, frankly, manipulation.
So how exactly is this new delta-based open interest calculation going to work, and what does future equivalent OI really mean for understanding market exposure.
Okay, so the shift is away from a simple notional open interest, which is just the total value of outstanding contracts, right?
Right.
It's moving to something called future equivalent, or FUTEC OI. This FUTEC OI uses a delta-based approach. Now, think of delta as how much a contract's value is expected to move for every, say, 1 rupee the underlying asset moves.
So it measures sensitivity to price changes.
Exactly. So instead of just counting how many contracts are open, SEBI is now measuring the actual risk exposure that those contracts represent. FUTEC OI will be calculated as the gross addition of these net positions across all unique client codes, or UCCs.
So it's more granular.
Much more granular and arguably a more realistic assessment of market positions. This improved calculation is designed to offer better risk assessment and significantly reduce the chances of, say, artificial ban periods occurring just due to high notional values but low actual risk.
And what about the market-wide position limits, or MWPL? How are those being redefined to better manage systemic risk?
The NWPL is also being redefined with a more sophisticated calculation. It will now be set as the lower of two things, either 15% of the free float market capitalization of a stock, or 65 times its average daily delivery value, ADDV, across clearing corporations.
Okay.
And there's a minimum floor of 10% of the free float. This new definition kicks in from October 1st, 2025 and will be recalculated quarterly.
Right.
And importantly, SEBI is also allowing specific risk reduction trades during F&O ban periods.
Oh, that's new.
Yes. Specifically, if a trade genuinely reduces the delta-based position, not just flips it from long to short or vice versa, that also takes effect on October 4th, 2025.
So this raises an important question, doesn't it? How does this comprehensive overhaul reshape risk management and liquidity in the derivatives market? What impact will it have on trading strategies for both institutional and individual investors?
That's the multi-billion-dollar question, really. It's undeniably a move towards a much more sophisticated and granular risk management system. The aim is clearly to reduce systemic vulnerabilities and maybe curb some of the more speculative excesses we've seen. How it plays out in terms of liquidity and strategy adoption, we'll have to watch closely as it rolls out.
It's a huge question given how essential the F&O market is to trading in India. Okay, lastly in this segment, the Indian Venture and Alternate Capital Association, IVCA, has urged legacy venture capital funds, or VCFs, to migrate to the AIF regime. What's the bigger picture here? It seems to be about bringing older investment structures into a more modern, streamlined regulatory environment.
That's absolutely the core objective. SEBI had introduced a migration framework back on August 19, 2024. It was specifically for those VCFs that were operating under the old, now repealed 1996 regulations.
Right, the really old one.
Exactly. This framework allows these older VCFs to transition into the current AIF regime under a new subcategory they've created called Migrated Venture Capital Funds, or MVCFs.
And what are the eligibility criteria and benefits for these VCFs to make the switch? Is a smooth process they're offering?
Well, to be eligible for migration, VCFs must either have schemes whose liquidation period has not yet expired, or they must have at least one scheme whose liquidation period has expired but still holds unliquidated investments, so funds that are still active, basically.
Okay.
The benefits of migrating are quite appealing. It offers a simplified re-registration process, some fee waivers, and tailored compliance requirements specifically designed for these MVCFs.
So making it attractive to switch.
Yes. And for VCFs that have already wound up all their schemes or have no investments left, IVCA is advising them to simply surrender their old registration to SEBI. This whole move is really about streamlining and modernizing India's investment landscape. Ensure that all major capital structures operate under a consistent and robust regulatory framework that enhances investor confidence and overall market integrity.
Now let's pivot to the very heart of India's financial system, the Reserve Bank of India. They've been incredibly busy, it seems, on multiple fronts. Everything from overseeing record profits within public sector banks to reforming critical payment systems.
Indeed. The RBI's actions consistently reflect its dual mandate, right? Maintaining financial stability across the entire system.
Stability first.
While simultaneously supporting broader economic growth. They achieve this through a strategic blend of direct regulation and more market-oriented measures, constantly adapting to the evolving economic landscape and, of course, global pressures.
And that adaptation seems to be yielding some remarkable results, especially for public sector banks, the PSBs. We're hearing about record profits for them. Can you give us the details and explain what's driving this impressive turnaround?
It's truly a remarkable turnaround story. The 12 PSBs collectively reported a record profit of 1.78 lakh crore in FY25.
1.78 lakh crore.
Yes. This marks a significant 26% growth over their FY24 performance. It's really a testament to years of diligent effort. State Bank of India, as you might expect, was a major player, contributing over 40% of that total profit with roughly 70,900 crore.
Okay, SBI leading the charge.
But what's particularly noteworthy is Punjab National Bank, PNB. They reported the highest profit growth at an astounding 102%.
Wow, doubled their profit.
Pretty much. Other significant gainers, each with over 40% profit growth, include Central Bank of India, UCO Bank, and Bank of India. This level of profit surge is a dramatic reversal from the significant losses they collectively saw back in FY18, which totaled around 85,000 crore.
That's a huge swing.
It is. This profound reversal highlights the success of concerted efforts to strengthen the banking system and, critically, clean up those balance sheets. The growth drivers are largely attributed to the government's 4R strategy.
Remind us of the 4Rs.
Recognizing non-performing assets, NPAs, properly, undertaking rigorous resolution and recovery efforts, recapitalization of the banks where needed, and implementing broader reforms in governance and operations.
Right.
And it's worth noting, the government infused a massive 3.11 lakh crore into PSBs between 2016-17 and 2020-21. That played a crucial role in ensuring their stability and preventing defaults during a very challenging period.
That's a testament to sustained reforms and clearly that capital infusion. Shifting now to how the RBI gathers intelligence for its critical monetary policy decisions, they've launched 3 important new surveys. What are they trying to understand with these, beyond just the hard economic numbers?
The RBI has initiated 3 key surveys to gather vital insights that directly inform its monetary policy decisions. There's the Inflation Expectation Survey of Households, or IESH, which focuses on subjective assessments of price movements and inflation across 19 major cities. Then there's the Urban Consumer Confidence Survey, UCCS, collecting qualitative responses from urban households, their sentiments about the economic situation, employment, prices, income, spending plans.
So how people are feeling in the cities.
Exactly. And finally, the Rural Consumer Confidence Survey, or CCS, which targets households in rural and semi-urban areas across 31 states and union territories, with a similar focus on economic perceptions and sentiments outside the main urban centers.
This is where it truly gets interesting, I think. The RBI isn't just looking at economic models and cold statistics. They're actively trying to understand the actual pulse of the nation, right? How people feel about the economy. That qualitative data must be incredibly valuable for nuanced policy making.
Absolutely. Understanding consumer and household sentiment is crucial for a central bank. It provides a nuanced perspective that goes beyond mere quantitative data. It helps the RBI gauge public confidence and, importantly, expectations.
And those expectations influence behavior.
Precisely. These sentiments, in turn, directly influence consumption and investment patterns, which ultimately impact inflation and broader economic growth. It helps them anticipate behavioral responses to policy changes much better.
Now, a big move from the RBI that could significantly attract more foreign capital. They've relaxed rules for foreign portfolio investors, FPIs, when it comes to investing in Indian corporate bonds. What were the previous restrictions and how have they been eased?
Right, this was a significant move. The RBI has essentially removed caps on short-term debt investments for FPIs in Indian corporate bonds. The clear aim is boosting foreign inflows into that market.
What were the caps before?
Previously, FPI's investments in corporate bonds with a residual maturity of up to 1 year were capped at 30% of their total corporate bond investments in India.
Okay, a 30% limit on short term.
Yes. And additionally, an FPI's investment in any single corporate debt security was further restricted 15% of the prevailing investment limit for long-term FPIs and 10% for others.
The concentration limits too.
Exactly. Although these limits didn't apply to those using the voluntary retention route, the VRR, which already offered greater flexibility. The RBI has now withdrawn both these short-term investment limits and the concentration limits entirely, effective immediately.
Wow, okay. What are the broader implications of this relaxation? For foreign capital flows and maybe for the depth of the Indian corporate bond market itself?
Well, this relaxation is a very strong signal, isn't it? India is keen to attract more foreign capital into its corporate bond market, make it more dynamic. By removing these restrictions, the RBI is making it significantly easier and more attractive for FPIs to invest, particularly in shorter-term corporate debt.
Which could improve liquidity.
Exactly. This can help deepen the market, improve its liquidity, and potentially lower borrowing costs for Indian companies as they gain access to a wider pool of global capital. It also encourages a broader base of foreign investors, because those who prefer shorter duration assets or maybe seek more flexibility now face fewer constraints.
Shifting focus slightly, the Fixed Income Money Market and Derivatives Association of India, FIMMD, has just received a significant recognition from the RBI. They've been recognized as the very first self-regulatory organization, or SRO,
Yes, first under the new framework.
under RBI's new 2024 framework. What does this mean for FIMDA and the markets they oversee?
This is a landmark development, really, for FIMDI and for the Indian financial markets. The RBI introduced this comprehensive framework for recognizing SROs in financial markets only in 2024, and FIMDA is the first to achieve this coveted status.
So what does FIMD actually do?
FIMDA itself was established way back in 1998. Its core objective is supporting the development and regulation of the fixed income, money market, and derivatives markets in India. It functions as a self-regulatory industry body, representing banks, dealers, various financial institutions. Its key functions include calculating daily valuations for government securities and corporate bonds, and administering benchmark Indian rupee interest rates like MIBOR. Its membership includes scheduled commercial banks, primary dealers, public financial institutions, insurance companies, basically all the major players.
So what changes with this SRO recognition?
This SRO recognition empowers FIMDA to take on a more proactive role, enhance market oversight and governance, align market practices directly with RBI guidelines, and foster greater discipline and integrity within these crucial financial segments. It's essentially a step towards shared responsibility in market development and regulation between the RBI and the industry body itself.
Now, for a truly staggering number that directly impacts a government's finances, the RBI has approved its highest ever surplus transfer or dividend payout to the central government for FY25. How large is this, and what's driving such an unprecedented figure?
The RBI has indeed approved an unprecedented surplus transfer. We're talking euro 2.69 lakh crore to the central government for FY25.
2.69 lakh crore.
Yes, this is a substantial 27.37% increase over the 2.1 lakh crore paid in FY24, which itself was a record. So smashing the previous record.
What led to such a huge jump?
Several factors converged, really. We're looking at robust dollar sales by the RBI in the foreign exchange market, which led to higher foreign exchange gains. There's also been a significant increase in interest income from their domestic and foreign assets.
Okay.
Plus, substantial mark-to-market, or MTM, gains on the RBI's holdings of rupee-denominated securities. That was primarily driven by a decline in government securities, or GSEC, yields.
Falling yields boosted the value of their holdings.
Exactly. And furthermore, the contingency risk buffer, the CRB, that's a fund the RBI maintains for unforeseen contingencies, that was also increased from 6.5% to 7.5% of their balance sheet. So the RBI strengthened its own buffer and transferred a record amount.
Right, indicating good health. What are the expected impacts of this massive dividend payout on India's broader economy and the government's fiscal position?
Well, this substantial dividend is expected to have several significant positive impacts. Firstly, it will substantially help in reducing India's fiscal deficit. The target is 4.4% in FY25, right?
Right.
So this gives the government significant breathing room. It eases pressure on government finances, especially amidst continued capital expenditure plans and various social programs. Secondly, it injects substantial liquidity into the banking system.
Which could boost lending.
Exactly. It can support increased lending and potentially stimulate overall economic activity. This strong transfer also underscores the RBI's robust financial health and its adherence to the economic capital framework based on the Bimal Jalan Committee recommendations. It ensures a balanced approach.
But does such a large payout raise any questions?
Well, while it boosts government coffers and liquidity in the short term, this unprecedented payout also sort of implicitly reignites the perennial debate on the optimal size of central bank capital buffers versus fiscal needs. It's always a delicate tightrope walk for any developing economy's central bank.
Moving on to governance, in the rapidly evolving payment sector, the RBI has officially notified the formation of a new Payments Regulatory Board, or PRB. What's changing structurally here, and who will actually comprise this new board?
The formation of the new 6-member PRB is a significant structural shift in how India's payment systems are overseen. This is under the Payments and Settlement Systems Act of 2007. This PRB effectively replaces the existing Board for Regulation and Supervision of Payment and Settlement Systems, or BPSS.
So it's a reimagined oversight body. What does the composition look like? Who's on it? And how will decisions be made to steer India's digital payment future?
Okay, the new board will be chaired by the RBI governor, who serves as the ex officio chairperson. Its members will include the RBI deputy governor in charge of payment and settlement systems, one RBI official nominated by the central board, and crucially, 3 nominees from the central government.
Ah, 3 government nominees. That's interesting.
It is. Each board member will have 1 vote, and decisions will be taken on a majority basis. In the event of a tie, the chairperson, or in their absence, the deputy governor will have a second, or casting, vote.
Okay.
The PRB may also invite domain experts in payments, IT, law as permanent or ad hoc invitees. The principal legal advisor of RBI will be a permanent invitee, and the board is mandated to meet at least twice a year.
So this composition with significant government representation, does it raise any questions?
It certainly raises an important question about balancing central bank autonomy with government participation in overseeing this rapidly evolving digital payments ecosystem. Especially given the RBI had previously, voiced reservations about similar structures proposed in the past, it signals a dynamic interplay between various stakeholders now.
That's definitely a crucial aspect to consider for the future of digital payments. Speaking of which, Zixuk, a Hyderabad-based fintech startup, just received in-principle approval from RBI to issue prepaid payment instruments, or PPIs. What does this mean for Zixuk and maybe for you, the consumer?
This approval is quite significant for Zixuk. It means they can now issue their own branded prepaid wallets and cards. And crucially, it also enables them to facilitate UPI payments through third-party applications. Think Google Pay, Cred, Amazon Pay.
So they can plug into the existing UPI ecosystem.
Exactly. They're effectively joining a very competitive sector. And with this regulatory backing, they have the foundation now to innovate and expand their reach.
So what does this all mean for us, the users? It suggests that more players in the digital wallet space will likely mean more innovation, potentially better features, and certainly more choices for you in how you manage your everyday digital transactions.
Exactly right. Increased competition typically drives better features, enhanced user experience, and potentially more competitive fees or even rewards for consumers in the digital finance space. It's generally a win for the end user.
And to further enhance security and user confidence in UPI, the National Payments Corporation of India, NPCI, has mandated a new rule. UPI apps must display only bank-registered names of recipients during person-to-person and person-to-merchant transactions. That's effective June 30th.
Yes, this is a critical step. It's aimed squarely at enhancing security and transparency in our digital payment ecosystem. It directly addresses those long-standing concerns about cyber fraud using fake names.
Right. So the goal is to stop those misleading names.
Exactly. The objectives are clear. Prevent fraud involving misleading or fake beneficiary names, significantly improve trust and confidence in the whole UPI ecosystem, and also reduce transaction disputes caused by name mismatches. By ensuring that only verified names linked directly to bank accounts are displayed, it dramatically reduces the scope for fraudsters to deceive users with false identities during transactions. It should make every payment feel more secure.
Beyond these specific changes, we also have a few other important banking and regulatory updates from May 2025. These seem to reinforce the RBI's consistent oversight. I understand the RBI has levied penalties on various banks recently.
Yes, the RBI has continued its vigilance. They imposed penalties on several prominent banks in May, including Axis Bank, ICICI Bank, Bank of Maharashtra, IDBI Bank, Bank of Baroda, SBI, and Jaina Small Finance Bank.
Quite a few. What were the reasons?
They were for non-compliance with a whole range of norms, really, covering everything from unauthorized entries, cybersecurity issues, KYC violations, overcharging interest, improper management of dormant accounts, and general loan norms. It just underlines the RBI's ongoing commitment to ensuring strict regulatory adherence across the entire banking sector. No letting up.
And there's a new mandate regarding the PRAVH portal for regulatory applications. What's that about?
That's right. From May 1st, 2025, all regulatory applications to the RBI must now be submitted exclusively via this PRAVH portal. This applies to a wide array of entities regulated by the RBI banks, non-banking financial companies, NBFCs, payment operators, you name it.
So centralizing everything online.
Exactly. The objective is clear. Centralize, digitize, and streamline the entire process of seeking approvals from the RBI. Make it significantly more efficient and transparent for all stakeholders involved.
Also, an update on India's gold reserves for FY25. What's the trend there? Is the RBI still buying gold?
Yes, India's gold reserves saw a notable increase in FY25. The RBI purchased 57.5 tons, which was the second highest purchase in the last 7 years. This brought total gold holdings to a substantial 879.6 tons.
Nearly 880 tons.
Yes, and the value of these holdings also saw a significant rise, appreciating over 30% year-on-year in rupee terms and about 24% in US dollar terms.
Wow, what's driving that?
It's largely driven by global instability and, of course, rising gold prices globally. It reflects the RBI's strategic move to diversify its reserves and bolster its balance sheet in uncertain times. Gold is seen as a safe haven.
In an interesting geopolitical move, India's financial support to the Maldives. What was the nature of that support?
India rolled over a $50 million treasury bill for the Maldives, essentially reinvesting the matured amount into a new bill, extending the repayment period for them.
Why now?
Well, this assistance comes at a critical time. The Maldives is facing significant economic distress. Public debt is over 134% of GDP, strained foreign reserves. This move powerfully reinforces India's neighborhood-first policy, and it's also, let's be frank, a strategic gesture amidst ongoing rivalry for influence in the vital Indian Ocean region.
Right, strategic considerations too. Finally, a quick note on new currency. Any changes for the everyday user that we should be aware of?
The RBI has announced new Mahatma Gandhi New Series Dorney notes. These will feature the new RBI governor's signature, Sanjay Malhotra. But it's really important to clarify for you, the listener. All existing euro notes will continue to remain legal tender.
Okay, so no panic. Old notes are still fine.
Exactly. No need for concern or any immediate action on your part.
Okay, moving beyond specific regulations and banking updates now, let's zoom out and look at the broader economic picture. What's truly fascinating here, I think, is how India seems to be balancing this robust growth with ongoing, pretty significant structural reforms.
Exactly. This section is really about connecting the dots across various economic indicators. We'll explore how policy decisions, investment trends, real-world economic activity, how they're all intertwined. It paints a comprehensive picture of India's impressive growth trajectory and, its future potential.
Kicking things off with a significant global endorsement then. Morningstar DBRS, a major credit rating agency, has upgraded India's credit rating. This feels like a big vote of confidence from a global agency, suggesting a very positive long-term outlook for India's economy.
It absolutely is a strong signal of confidence. Morningstar DBRS upgraded India's long-term foreign and local currency issuer ratings. They moved from BBB, low, up to BBB, both with a stable trend.
Okay, solid investment grade.
Yes. And similarly, the short-term ratings were upgraded from R2 middle to R2 high, also with a stable outlook. This upgrade reflects several key factors: India's ongoing structural reforms, significant infrastructure investment, and those wide-ranging digitalization efforts we keep talking about.
And these are having a real impact.
According to DBRS, yes. These initiatives have visibly led to consistent fiscal consolidation and enhanced macroeconomic stability overall.
What specific economic performance indicators stood out to the rating agency as key drivers for this upgrade? Did they mention specifics?
They did. India has demonstrated strong average GDP growth, 8.2% from FY22 to FY25. That's coupled with commendably controlled inflation, a stable exchange rate, and a healthy external balance. Furthermore, the banking sector, as we discussed, has shown remarkable resilience and strength. High capital adequacy ratios, the lowest non-performing assets, NPAs, in 13 years.
Right, the PSB turnaround.
Exactly. That robust banking health significantly bolstered the rating. Morningstar DBRS also indicated that further reforms, ones that boost investment rates and successfully lower the public debt to GDP ratio, could potentially lead to additional upgrades in the future.
What about the high public debt level? Is that still a concern?
Well, while public debt remains high, the agency noted that its long maturity profile and the fact that it's predominantly denominated in local currency helps mitigate debt sustainability risks. It makes India less vulnerable to external shocks compared to countries with high foreign currency debt.
Let's get a snapshot then of India's key economic indicators for FY 2024-25 and the outlook for FY 2025-26. This should give us a clearer picture of the current economic pulse. Starting with retail and food inflation in April 2025, what do the numbers tell us about consumer prices? Are things cooling down?
Yes, quite significantly in April. Retail inflation fell to 3.16%. That's its lowest level since July 2019. And it marked the third consecutive month it remained comfortably below the RBI's 4% target.
What drove that?
It was largely driven by a good harvest, apparently, despite some localized heat waves impacting certain crops. Food inflation also dropped significantly to 1.78%, its lowest since October 2021. Interestingly, urban food inflation was slightly lower than rural.
And the implication for the RBI.
This easing inflation provides crucial headroom, right? It gives potential flexibility for future monetary policy decisions, maybe allows the RBI more leeway in its approach if growth needs support.
What about the Index of Industrial Production, or IIP, growth for April 2025? That indicates manufacturing activity, correct?
Correct. IIP growth actually slowed to 2.7% in April. That was an 8-month low. It was mainly due to weaker performance in the mining and electricity sectors.
But manufacturing?
Manufacturing saw a modest increase of 3.4%, and capital goods recorded strong growth of 20.3%, though it has to be said this is partly boosted by a low base effect from the previous year.
Okay, so a mixed picture there.
A bit mixed. Consumer non-durables, unfortunately, contracted. That indicates some patchy demand across various categories and signals a somewhat uneven recovery in industrial activity so far.
How did India's GDP grow in FY25 overall? And what are the international forecasts looking like for its economic trajectory? Is India still seen as a bright spot?
Okay, for the full fiscal year FY25, India's GDP growth came in at 6.5%. That was its lowest since the pandemic hit year of 2020-21. However, the fourth quarter, the last quarter of that year, saw a faster growth rate of 7.4%. That marked the quickest expansion within that year.
What sectors drove the Q4 growth?
Manufacturing grew by 4.5% in Q4, and construction by an impressive 9.4%. Consumption growth also picked up to 7.2%, reflecting improving domestic demand towards the year-end.
And the global view?
If we connect this to the bigger picture, yes, despite some global headwinds and maybe some internal inconsistencies, India is consistently seen as a global growth outlier. Forecasts from various international bodies highlight this. The IMF, for instance, expects India to grow at 6.2% in FY26 and 6.3% in FY27.
And they project India becoming the fourth largest economy soon.
Yes, surpassing Japan, potentially by FY26. The UN also forecasts 6.3% GDP growth for India in 2025. So the consensus is still strong positive growth relative to the rest of the world.
And what about India's trade balance and foreign direct investment, or FDI, trends? Are we seeing strong global engagement there?
Well, the trade deficit widened slightly to $8.65 billion in April 2025. For the full fiscal year ending March 2025, total exports reached a record $824.9 billion, which was up 6% year-on-year. Merchandise exports specifically grew by 9% to $38.49 billion in April. However, imports saw a larger jump of 19.1% to $64.91 billion in April.
So imports grew faster than exports in April.
Yes, but services exports remained a strong point. They came in at $35.31 billion in April, up 17%, consistently contributing to a significant services trade surplus, which helps offset the merchandise deficit.
Okay, and FDI. There were some headlines about a slump.
Right, the headline number for net foreign direct investment looked quite dramatic. It slumped by 96% in FY25 to just $353 million. However, it's crucial to understand the nuance here.
Okay, what's the nuance?
This doesn't necessarily indicate a lack of foreign interest in investing in India. Gross FDI actually remained robust at $81 billion, which was a 3-year high.
So money came in,
But more money went out, or didn't stay. The slump in net FDI was primarily due to 2 factors. Increased repatriation of profits by foreign firms already invested here.
taking profits home.
Yes, and higher outward FDI by Indian companies investing abroad. So these outflows effectively reduce the net inflow number. It's more about complex capital movements than a straightforward decline in foreign appetite for India as an investment destination.
That's a really important distinction that often gets missed in the headlines. Let's dig deeper into India's export performance then. What key sectors are truly driving India's merchandise exports and shaping its global trade profile?
In 2024-25, 4 key sectors really stood out. Agriculture, pharmaceuticals, electronics, and engineering goods together, they made up over 50% of India's merchandise exports.
Over half from just those 4. That's significant diversification.
It really highlights the diversification beyond maybe more traditional areas. Engineering goods led the pack with a substantial 26.67% share, followed by agriculture at 11.85%, electronics at 8.82%, and pharmaceuticals at 6.96%.
You know, electronics growth was particularly strong.
Phenomenal, actually. Electronics exports saw a 32.46% growth overall. Within that, computer hardware and peripherals grew by an astounding 101%. Pharma exports, growing at a healthy 9.4%, reached over 200 countries. Even rice exports hit a record $12.5 billion. It showcases India's growing global presence in manufacturing and services and also continued agricultural strength.
That's a powerful story of diversification and growing global competitiveness. And speaking of growth, India's renewable energy capacity has seen a massive surge over the last decade. How significant has this transformation actually been?
This is a truly remarkable success story. It really demonstrates India's commitment to green energy. India's renewable energy capacity, including large hydro, has basically tripled in just a decade. It soared from about 75.5 GW in 2014 to an impressive 232 GW in 2024.
Tripled in 10 years.
Yes. Solar energy alone grew dramatically from a mere 2.82 GW to 108 GW, and wind capacity more than doubled to 51 GW. This firmly establishes India as a global leader in green energy deployment.
Yeah, it's not just capacity addition, right? What about manufacturing?
That's a key point. Domestic solar module manufacturing capacity has surged in parallel, from just 2 GW in 2014 to an impressive 90 GW now. That reflects significant local industrial growth and reduced import dependency. Biopower capacity also rose by 42%, and compressed biogas, or CBG capacity, has expanded significantly too.
So it's not just about adding capacity, but also building a robust domestic manufacturing ecosystem to support it. What about government initiatives and future targets in this space? This feels like a remarkable success story, showing how policy push combined with private initiative can drive massive change.
It absolutely is. Government initiatives like the PM Surya Ghar Muft Bijli Yojana, the rooftop solar scheme, have been instrumental. It directly benefited 1.3 million households and led to 1.2 million rooftop solar installations in just the past 10 months alone.
Huge uptake.
Yes. India added a record 25 GW of renewable capacity overall in 2024, which was a 34.63% increase over the previous year. The ambitious national target is to reach 500 GW of non-fossil fuel capacity by 2030.
500 GW by 2030.
Yes. And India has already cemented its position as the world's third-largest producer of electricity from wind and solar, even overtaking Germany in 2024. Key public sector agencies like SECI and TPC, NHPC, SJVN, they've collectively floated 44 GW of renewable tenders just in FY 24-25. That indicates a really strong pipeline to ensure these aggressive future energy goals are met. Continued growth looks very likely.
That's truly impressive progress on the green energy front. Now, looking at the foundational aspects of the economy, how did the Index of 8 Core Industries, or ICI, perform in April 2025? These industries are often seen as bellwethers for overall economic activity, aren't they?
They are indeed. The Index of 8 Core Industries, which collectively constitutes just over 40% of the overall index of industrial production, saw a modest rise of 0.5% in April 2025 compared to April 2024, so slight positive growth year on year.
Which sectors drove that growth?
Positive growth was observed in key sectors such as coal, cement, steel, electricity, and natural gas.
And what were the detailed performances? Were there any areas of concern within those 8 core industries?
Well, while coal production increased by 3.5%, showing consistent growth, there were some areas of contraction in April. Crude oil output fell by 2.8%, and refinery products saw a decline of 4.5%. Fertilizer production also dropped by 4.2% in that month.
Okay.
On the positive side, steel, cement, and electricity continued to show consistent growth, not just in April 2025, but over the entire previous financial year as well. These core industries are indeed bellwethers, as you said. Their performance provides crucial insights into the underlying momentum and any potential bottlenecks within the broader economy.
Moving on to another key indicator of economic health, GST collection. It hit a record high in April. What's really behind this surge, and what does it tell us about the state of the economy?
GST collection rose by a strong 12.6% year-on-year to an unprecedented record of 2.37 lakh crore in April.
Another record broken.
Yes, this surpasses the previous second highest collection, which was 2.0 lakh crore just the year before, in April 2024. The primary drivers for this surge seem to be twofold. Robust economic activity, signaling strong consumer demand and business transactions.
Good underlying health.
Right. And also the typical year-end book reconciliation by businesses, which often leads to higher payments in April, the first month of the new financial year. Revenue from domestic transactions increased by a solid 10.7%, while revenue from imported goods saw an even higher jump of 20.8%.
And net collection after refunds.
Even though refunds surged by 48.3%, the net GST collections still remain exceptionally strong at over 2.09 lakh crore after adjustments. What's truly fascinating here is that this high collection signals very robust economic performance, particularly as it captures activity from March, the last month of the previous fiscal. It provides a strong indicator of underlying economic momentum being carried forward into the new financial year.
And parallel to that, mining production also saw robust growth in FY 2024-25. Which minerals stood out in this performance?
India's mineral production saw strong growth in FY 2024-25, yes. It was significantly led by iron ore, which rose by 4.3% to a record 289 million metric tons. Iron ore accounted for a substantial 70% of total MCDR mineral production by value.
Wow, iron ore dominating. What else?
Manganese ore production increased by a healthy 11.8%, bauxite rose 2.9%, and lead concentrate also grew by 3.1%. In the non-ferrous sector, primary aluminum production reached a record 42 lakh tons, and refined copper rose 12.6%.
And why is this growth significant?
It's highly significant because it directly correlates with demand from key downstream sectors, right? Steel, energy infrastructure, automotive heat, they all need these minerals. So this growth indicates broad-based industrial activity and demand.
And how does India stack up globally in these key mining areas? Are we a major player?
We certainly are in some areas. India is currently the second largest aluminum producer globally. We rank among the top 10 in refined copper, and we're the fourth largest iron ore producer worldwide. These statistics really underscore India's growing importance in the global mining landscape and its increasing capacity to meet the raw material demands of its burgeoning industrial sectors, which helps reduce reliance on imports for critical inputs.
Shifting gears now to infrastructure and logistics. India seems to be making some impressive strides here that could fundamentally change how goods move across the country. Tell us about the Vizhinjam port. What's special about it?
The Vizhinjam International Seaport down in Kerala is set to be a true game changer for India's trade. It's an all-weather deep draft transshipment hub, and it utilizes advanced AI-driven systems for real-time ship tracking and traffic management, making it highly efficient.
And its main goal is transshipment, handling cargo destined for other ports.
Exactly. Its strategic location and deep draft capabilities aim to significantly reduce India's current reliance on foreign ports like Colombo or Singapore, which currently handle a staggering 75% of India's transshipment cargo.
75%, that's huge.
It is. And this dependence cost India an estimated $220 million annually in extra logistics costs. So the new port offers substantial cost savings and drastically improved efficiency for Indian trade and supply chains. It really enhances India's logistical sovereignty.
That's a huge potential saving and a major strategic advantage. And I hear there's also a renewed push for inland waterways, using rivers for transport.
Yes, recognizing the cost-effectiveness and environmental benefits of water transport, the Inland Waterways Authority of India, IWAI, has signed a crucial Memorandum of Understanding, MOU, with Rennis Logistics India.
Okay. What does the MOU entail?
This partnership will see Rennis Logistics operating barge services across key national waterways like NW1 on the Ganga, NW2 on the Brahmaputra, NW16 in the Indo-Bangladesh Protocol routes. They plan to deploy around 100 cargo vessels.
100 vessels? That's a serious commitment.
It is. This directly supports the ongoing Jal Marg Vikas project, aiming to build a more resilient multimodal logistics system, significantly lower transportation costs, and boost the competitiveness of inland water transport. India has also expanded its operational waterways to 29 now and introduced schemes like Jal Vahak to further incentivize cargo movement. Shows a comprehensive push to leverage India's extensive river network.
What about airport development, particularly smaller private airports? Is growth concentrated there, or is it across the board?
According to CRISIL analysis, capital expenditure, or CapEx, at small private airports is actually set to rise significantly by 50 to 60% during the period 2026-2028.
Why the surge at smaller airports?
It's primarily driven by the need for capacity expansion. As regional air travel grows, terminal utilization levels are getting higher, triggering the need for upgrades and expansion at these smaller hubs. In contrast, the large private airports are expected to see a slight dip in CapEx.
Oh, why is that?
Because their major expansion phases are mostly nearing completion now. So overall, total private airport CapEx is anticipated to dip slightly, by maybe 10–15% to about 40,000 crore over the next 3 years. It signals a bit of a shift in investment focus towards enhancing regional connectivity. This comprehensive push across ports, waterways, and airports is crucial for reducing logistics costs, improving overall efficiency, and ultimately boosting India's competitiveness in global trade.
Beyond just economic numbers and infrastructure, India has also been deeply focused on social security and agricultural initiatives that directly impact millions of lives. Let's start with the 3 Jan Suraksha schemes. PMSBY, PMJJBY, and APY, which just completed 10 years. This truly represents a direct impact on the lives of millions, doesn't it? Providing a vital safety net for the most vulnerable.
Indeed, it does. These schemes, launched back on May 9, 2015, were specifically designed to provide affordable Social Security and financial inclusion, targeting the poor and vulnerable segments of society. And the scale is impressive. As of April 2025, they've seen remarkable enrollment figures.
How many people are covered?
We're talking 23.6 crore enrolled under Pradhan Mantri Jeevan Jyoti Bima Yojana, PMTJBY, the life insurance one, a massive 51 crore under Pradhan Mantri Suraksha Bima Yojana, PMSBY, the accident insurance, and 7.6 crore under Atal Pension Yojana, APY, the pension scheme.
Huge numbers. And have claims been paid out effectively?
Yes, cumulatively. Over 18,398 crore has been disbursed under PMJJBY and 3,121 crore under PMSBY. That has benefited lakhs of families, providing crucial financial support in times of death or disability.
Can you briefly remind us of what each scheme offers? They all serve slightly different but equally vital purposes, right?
Certainly, PMJJBY provides a 2 lakh life insurance cover for death due to any cause, at an incredibly affordable annual premium of just $436. PMSBY offers accidental death or total permanent disability cover of up to 2 lakh for a nominal premium of only 22 per annum.
20 rupees a year.
Incredible, isn't it? And Atal Pension Yojana, APY, provides a guaranteed monthly pension ranging from 1,000 to 5,000 after the age of 60, depending on the contributions made during the working years.
And technology played a role.
A major achievement across all these schemes has been their extensive digitization. That has enabled easy enrollment, often linked directly through bank accounts, and significantly faster claim settlements. It truly reflects the vision of securing the unsecured and reaching millions who were previously outside any formal safety nets.
Now, on to support for the vibrant startup ecosystem. The government has revised the Credit Guarantee Scheme for Startups, or CGSS. What are the key enhancements here for new businesses looking for funding?
The maximum guarantee cover per borrower under the CGSS has been doubled. It went from 10 crore up to an impressive 20 crore.
Doubled the guarantee cover.
Yes. This scheme fundamentally aims to provide collateral-free debt funding to eligible startups, easing their access to crucial capital, which is often a major hurdle. It offers an 85% guarantee cover on defaults for loans up to 10 crore and 75% for loans exceeding 10 crore.
So the government shares a large part of the lender's risk.
Exactly. Additionally, the annual guarantee fee has been reduced for startups operating in 27 designated champion sectors areas the government wants to promote. The objective here is clear. Significantly reduce lending risks for banks and NBFCs, thereby boosting R&D, fostering innovation in the startup ecosystem, and aligning directly with the Union Budget 2025-26's focus on encouraging entrepreneurship.
And in the microfood process sector, the Pradhan Mantri Formalization of Microfood Processing Enterprises, or PMFME, scheme seems to be making significant progress. Bihar was leading the way.
Yes, Bihar notably led in the implementation of the PMFME scheme for FY 2024-25, with over 10,000 loan approvals credited to them. This scheme, which is active until 2025-26, with a substantial 10,000 crore outlay nationally, offers a 35% credit-linked subsidy to individual microfood processing units.
Okay.
And it also provides crucial support for establishing common facility centers shared infrastructure, like cold storage or packaging units. Its core objective is to formalize the largely unorganized microfood processing sector, improve food safety standards, and importantly, empower women and create livelihoods in rural areas by transforming these informal businesses into recognized, more viable enterprises.
Speaking of agriculture, what's the latest update on the fair and remunerative price, or FRP, for sugarcane? That's a critical support price for millions of farmers.
The Cabinet Committee on Economic Affairs approved an increase in the fair and remunerative price for sugarcane. For the upcoming 2025-26 season, it's set at $355 per quintal, up from $340 in the previous season.
Okay, an increase of 15 rupees.
Yes. This price is based on a standard sugar recovery rate of 10.25%. However, there's a floor price. A minimum of $329.05 per quintal is guaranteed, even if the recovery rate drops below 9.5%.
Protecting farmers even with lower recovery.
Correct. This increase is estimated to provide a significant profit margin for farmers. And it's important context to note that a remarkable 99.92% of sugarcane dues were reportedly cleared in the 2023-24 season, indicating efforts towards ensuring timely payments to growers, which has historically been an issue.
And what about new regulations for sugar mills and also Kansari units? Are they aimed at ensuring transparency and fair payments too?
Yes, exactly. The government has mandated digital reporting of sugar production and sales by mills. This replaces cumbersome manual submissions and aims to enhance transparency and efficiency in tracking sugar stocks. And, significantly for the first time, Kansari units, which produce a type of unrefined sugar with a crushing capacity above 500 tons crushed per day, TCD, are now being regulated.
Why regulate Kansari units?
To ensure timely FRP payment to farmers who supply cane to them, bringing greater accountability to this previously less regulated segment. Raw sugar production has also been explicitly included under regulation to prevent misleading marketing practices and potentially curb diversion of cane. These measures aim to reduce data leakages and provide more accurate estimates of total sugar output, benefiting both farmers and the industry's planning.
And an interesting development regarding the use of FCI rice for ethanol production. What's the context behind this decision?
An additional 2.8 million tons of rice from the Food Corporation of India, XCI stocks, have been approved for ethanol production. This brings the total allocation to 5.2 million tons for the ethanol supply year, ESY, 2024-25. The rice is priced at 22.5 euro per kilogram for the distilleries.
Why use rice for ethanol?
This supports the government's ethanol blended petrol, or EBP, program. The goals are reducing pollution from vehicles and cutting down on India's hefty fossil fuel import bill. While it aids the national goal of achieving 20% ethanol blending in petrol by ESY 2025-26, it has, understandably, raised some concerns and debate about potentially diverting food grains from direct consumption towards fuel production. It's that classic food versus fuel debate, balancing energy security with food security needs.
What about interest subvention for farmers? Is there continued support for making agricultural credit more affordable?
Yes, absolutely. The Modified Interest Subvention Scheme, or MIS-S, for farmers has been continued for the financial year 2025-26. Under this vital scheme, farmers can avail short-term agricultural loans up to $3 lakh at an initial interest rate of 7%. However, with a 1.5% interest subvention provided by the government and an additional 3% prompt repayment incentive, PRI, for those who repay their loans on time.
Ah, the incentive for good borrowers.
Exactly. The effective interest rate can be reduced to just 4%. That's a significant relief. For farmers engaged specifically in animal husbandry and fisheries, this benefit applies for loans up to $2 lakh.
And how many farmers benefit?
This scheme benefits over 7.75 crore Kisan credit card KCC accounts. It significantly boosts the flow of institutional credit to farmers and helps them manage their operational costs more effectively.
There's also a new campaign mentioned, Viksit Krishi Sankalp Abhiyan. What's its specific focus?
This campaign was recently launched at the Odisha University of Agriculture and Technology, OUAT, in Bhubaneswar. It aims to fundamentally transform Indian agriculture by fostering direct interactions between farmers and agricultural scientists at over 2,170 locations nationwide.
Bridging the lab-to-land gap.
Precisely. It supports farmers through various means, including promoting awareness about schemes like interest subsidies on KCC loans, and emphasizes crucial areas like improving irrigation and increasing crop insurance coverage. It's part of India's broader aspiration, often stated, to become the food bank of the world, highlighting the strategic importance and ongoing modernization efforts in the agricultural sector.
And what about the minimum support prices, or MSP, for Kharif crops? Has there been an increase announced for the upcoming season?
Yes, the Cabinet has indeed approved an increase in the minimum support price for 14 designated Kharif crops for the 2025-26 marketing season. The estimated financial implication or outlay to support this is around 2.07 lakh crore.
Which crops saw the biggest hikes?
The highest absolute increase was for Niger seed, followed by ragi and cotton. This signals an intent to promote cultivation of these specific crops, including nutricereals like ragi. This aligns with the government's stated policy of setting MSP at least 1.5 times the weighted average cost of production for farmers. It aims to ensure fair returns and encourage diversification, alongside continued efforts to increase government procurement of these crops.
A unique initiative mentioned was the Fish Festival and Integrated Aqua Park in Tripura. What are the objectives of this project in the Northeast?
The foundation stone for an integrated aqua park, funded under the Central Pradhan Mantri Matsya Sampada Yojana, PMSY, has been laid in Tripura alongside a lively state-level fish festival. This 42.4 crore project aims to create an integrated hub for fisheries development.
What will the hub include?
It's planned to comprise hatcheries, fish feed mills, cold storage facilities, and training centers all in one place. Its objective is to significantly boost fisheries infrastructure in the state, generate livelihoods, particularly for youth and women in the sector, and modernize fish production and processing techniques. Tripura actually has a remarkably high fish consumption rate, over 29 kilograms per capita per year, making this a critical initiative for local food security and economic development in the state.
And some exciting news from the Indian Council of Agricultural Research, ICAR, on genome-edited rice varieties. This sounds like a potential breakthrough for agricultural resilience, doesn't it?
It is a very significant breakthrough. India's first ever genome-edited rice varieties have been developed by ICAR scientists. These include DRR Dan 100 Kamala, which is derived from the popular Samba Masuri variety.
What are its advantages?
It matures 15-20 days earlier than the original, offers a remarkable 25% higher yield potential, and is also heat-tolerant and suitable for direct seeding methods, which saves water and labor. The second variety is Pusa DST Rice 1, derived from MTU 2010. This one is specifically salinity tolerant and provides significantly higher yields even in saline soil stress conditions.
Huge potential benefits there.
Absolutely. These scientific advancements promise to improve food security, enhance climate resilience for farmers facing weather extremes, and directly boost farmer incomes by increasing productivity and reducing risks. Also, on the agricultural technology front, Tanuka Agritech has launched a new herbicide called Dinkar. It was developed in collaboration with Japan's Hoko chemical industry. It's specifically designed to combat difficult early-stage weeds in transplanted paddy, further supporting crop health and yield potential.
So a combination of public sector research and private sector innovation.
Exactly. If we connect this to the bigger picture, all these initiatives from Social Security and credit support to MSP hikes and cutting-edge agricultural research truly reflect a holistic approach. It's about rural development, ensuring food security, and empowering the agricultural sector through a combination of policy support, technology infusion, and market mechanisms.
Finally, in our broader economic overview, let's talk about the ongoing modernization of India's public distribution system, the PDS, through new digital platforms. How is technology transforming this crucial food distribution system?
The Union Minister Prahlad Joshi recently launched 3 major digital initiatives aimed at revolutionizing the PDS. There's Depo Darpan, Anamitra, and Anasahayata.
Okay, what do they do?
Depo Darpan is a self-assessment portal for FCI and State Warehousing Corporation depots. It integrates Internet of Things, IoT devices, and CCTV footage to improve infrastructure monitoring and efficiency in food grain storage. Anamitra is a mobile app designed to provide real-time data and transparency to various PDS stakeholders, beneficiaries, fair price shop owners, officials. It's currently being piloted in 4 states.
And Anasahayata.
Anasahayata is a centralized grievance redressal system. It leverages multiple channels like WhatsApp, Interactive Voice Response System, IVRS, and Automatic Speech Recognition, ASR, making it easier for beneficiaries to raise concerns or complaints. This is now live in 5 states.
So the goal is better efficiency and accountability.
Exactly. The overarching objective is to modernize India's vast public distribution system, significantly strengthen transparency and accountability, and empower the over 81 crore beneficiaries who rely on it. Importantly, 1,280 crore has also been allocated specifically to upgrade FCI and Central Warehousing Corporation, CWC warehouses, addressing critical infrastructure gaps. This directly supports the Digital India and Viksit Bharat's visions, ensuring food reaches those who need it efficiently and transparently.
Finally, let's broaden our view even further. Let's look at India's place in the global economy and also touch upon some interesting shifts within its corporate landscape.
Right. This section really ties together how India's economic narrative is increasingly intertwined with global trade, international investment, and various diplomatic efforts. It highlights its evolving and, frankly, expanding position on the world stage.
A key step in bolstering international economic ties. India and Chile have signed the Terms of Reference for Comprehensive Economic Partnership Agreement, or CEPA, negotiations. This sounds like a significant deepening of their relationship, moving beyond just basic trade.
It is indeed a strong signal of deepening ties. The Terms of Reference were formally signed on May 8, 2025. This officially initiates the negotiations for a full-fledged CEPA. The core goal is to upgrade their existing Preferential Trade Agreement, the PTA, which has been in place since 2005 and was already expanded somewhat in 2016.
So what will the CEPA cover that the PTA didn't?
The scope of the proposed CEPA is quite broad and ambitious. It aims to cover a much wider array of sectors, including things like digital services, specific support for micro, small, and medium enterprises, MSMEs, cooperation on critical minerals, which is increasingly important globally.
So you're strategic now.
Absolutely, and robust investment promotion and protection clauses.
So what's the anticipated impact of this SEPA on trade and economic activity between India and Chile?
Well, this agreement is expected to significantly boost bilateral trade volumes further, create more employment opportunities in both countries, attract further investment across these newly covered sectors, and open up new export avenues for businesses in both nations. Ultimately, it aims to foster a more balanced and mutually beneficial partnership by delving into areas that go well beyond traditional goods trade, reflecting modern economic realities and supply chains.
Moving to another significant trade relationship, what are the current trends in India-UK goods trade? Is it a balanced partnership, or is one side benefiting more?
India's merchandise trade with the UK reached $19.3 billion in the fiscal year 2024-25 up to January, so showing steady overall growth. However, there's an interesting dynamic when you look closer.
Oh.
Imports from the UK into India have grown much faster. They've nearly doubled since 2016-17. Compared to that, India's exports to the UK grew by about 41% over the same period.
So the trade gap might be widening in the UK's favor.
It indicates a deepening economic relationship overall, yes, but also presents a challenge for India to balance the trade flows more evenly, potentially through the ongoing FTA negotiations.
What are the key sectors driving this trade, both in terms of India's exports to the UK and its imports from them?
For India's exports to the UK, the top 5 categories are electrical machinery, nuclear reactors and general machinery, mineral fuels, precious stones, and pharmaceutical products. Engineering exports in particular are projected to potentially double to $7.55 billion by 2029-30 if a comprehensive free trade agreement is finalized. That highlights significant potential there.
And what is India importing most from the UK?
On the import side, precious stones and machinery together account for a significant 65% of imports from the UK. That indicates key areas of reliance and supply chain integration between the two economies.
The cabinet has also approved a revised SHTA policy for coal allocation. This sounds like a crucial step towards ensuring energy security and maybe making coal allocation more efficient and transparent in India. What's changed?
Absolutely. The revised HKT policy, that scheme for harnessing and allocating Koyala transparently in India, it streamlines coal allocation into 2 distinct windows now.
2 windows. Okay.
Window I continues to provide coal supply at notified prices, primarily for central and state government-owned thermal power plants, TPPs, and their joint ventures. This ensures consistent energy supply for base load power. Window 2, however, offers auction-based coal access at a premium price.
Who can access window 2?
Any power producer, basically, with or without a long-term power purchase agreement, PPA, for a duration of up to 25 years.
That sounds much more flexible.
It introduces crucial flexibility. It allows power plants to potentially sell electricity freely on the exchanges or through shorter contracts. This should significantly improve participation from independent power producers, IPPs, and crucially, enable new thermal capacity additions which are still needed to meet India's growing energy demand.
Does it help with reducing coal imports?
It should. It also supports import substitution by allowing power plants that were previously designed or reliant on imported coal to access domestic coal through this auction route. That could reduce reliance on costly imports and ultimately benefit electricity consumers through potential cost savings passed on. This revised policy raises an important question, though, about how India is strategically balancing its need for energy security and affordability using domestic coal while simultaneously driving industrial growth and managing its climate commitments.
Another interesting development on the climate front. The center has unveiled a draft climate taxonomy document. This sounds like India's strategic move to clearly define what counts as green investment, right? Ensuring capital flows towards genuinely climate-aligned projects and, importantly, preventing greenwashing.
That's precisely right. The Finance Ministry recently released this framework of India's climate finance taxonomy. Its purpose is to provide clear guidance for investments into clean energy projects and climate-resilient infrastructure.
So a clear definition of green.
Exactly. This taxonomy aims to transparently identify activities that are genuinely aligned with India's ambitious climate goals, particularly its net zero by 2070 target. And as you said, importantly to prevent greenwashing, where investments might be deceptively labeled as environmentally friendly without real impact.
How does it fit into broader goals?
It aligns seamlessly with the national development vision of Viksit Bharat and actively encourages affordable, reliable energy while promoting climate-friendly technologies and practices. The document intelligently classifies sectors as either climate-supportive, like renewables, or climate transition.
Climate transition, what does that mean?
That focuses on enabling emission reduction and adaptation measures, even in traditionally hard-to-abate sectors like iron, steel, and cement, recognizing that they won't become green overnight, but need investment to improve. This is a critical and forward-looking step for India to efficiently direct capital towards its climate objectives and ensure genuine environmental impact from those investments. It also comes in the context of global debates, like at COP29, about defining climate finance. India is setting out its own clear framework.
Now, a proposed U.S. bill could have significant implications for the Indian diaspora and the flow of remittances back home. A 5% tax on remittances sent by non-citizens. This sounds like a potentially contentious proposal.
It is indeed. This proposed U.S. bill, backed by some Republicans, seeks to impose a 5% excise tax on international remittances sent by individuals who are non-U.S. citizens residing in the U.S.
How would this impact Indians in the U.S.?
If passed, it would directly affect the substantial Indian diaspora in the U.S., which comprises over 2.3 million people and sent an estimated $23 billion in remittances back to India in 2023 alone. The proposed tax wouldn't just apply to personal remittances sent to family.
Oh, what else?
It could also apply to transfers of investment income earned in the U.S. and even proceeds from selling restricted stock units, RSUs, granted by employers, even if those funds have already been subject to U.S. income tax.
Wow, that seems broad. What are the main concerns being raised by critics of such a proposal, both in the U.S. and for countries like India that receive these remittances?
Critics argue it unfairly targets legal immigrants, including H-1B visa holders and green card holders, while exempting U.S. citizens sending money abroad. Experts warn that if enacted, it could inadvertently drive remittances into informal or even illicit channels to avoid the tax.
Makes sense. People might try to bypass it.
Right. It could also increase pressure on U.S. employers to raise compensation for skilled migrants to offset this tax burden and potentially diminish the U.S.'s image as an attractive destination for global talent.
Yeah.
It also raises complex questions about potential overrides of existing tax treaties. This measure is currently in its early legislative stages in the U.S. It's not law yet, but it has certainly sparked debate and concern in the Indian community and among economists globally about the potential impact on crucial remittance flows.
Finally, a few miscellaneous updates on market infrastructure and corporate governance that highlight ongoing regulatory scrutiny and market evolution. We heard about SEBI barring some former IndusInd Bank executives. What was that about briefly?
Yes, SEBI recently passed an interim order barring 5 former IndusInd Bank executives, including the ex-CEO, from the securities market. This was related to alleged insider trading concerning discrepancies discovered in the bank's derivatives portfolio back in 2019. They were ordered to disgorge significant amounts, representing losses allegedly avoided through illegal trades. The investigation is ongoing, but it underscores SEBI's continued commitment to enforcing market integrity and acting against insider trading.
On the mutual fund front, Jio BlackRock received SEBI's nod. What does this mean for the asset management industry in India?
Jio BlackRock Asset Management PVT Ltd, which is a 50.50 joint venture between Jio Financial Services and the global giant BlackRock, received SEBI approval to operate as a mutual fund investment manager in India. This marks a significant entry of a new, very well-capitalized player into India's rapidly growing asset management sector. It promises increased competition, potentially more innovation, and certainly more diverse offerings for investors.
And the NSE and BSE, India's leading stock exchanges, are expanding their index offerings. What new indices have they launched?
Indeed. The National Stock Exchange, NSE, introduced the Nifty Waves Index. This comprises 43 listed companies from the media, entertainment, and gaming sectors, offering investors and analysts tailored insights into these dynamic and growing industries. It uses a free-float market capitalization method with a 5% cap on individual stock weights.
Okay, a thematic index. And BSE.
Meanwhile, BSE Asia Index unveiled 4 new factor-based indices. These are the BSE 500, Enhanced Value 50, Low Volatility 50, Momentum 50, and Quality 50. These are designed to capture specific market behaviors or factors and are rebalanced quarterly. It's part of BSE's strategy to regain market share in the index space and offer more sophisticated investment tools based on quantitative factors.
Lastly, any other regulatory tweaks or notable corporate news that rounded out the month of May?
Just a couple more. The Department of Economic Affairs quietly amended Rule 8 of the Securities Contracts Regulation Rules, 1957. This was aimed at improving the ease of doing business for stockbrokers by addressing some outdated provisions, part of a broader, continuous strategy to streamline and strengthen the financial ecosystem. Also, the insurance regulator, IRDAI, imposed a 1 crore penalty on ACO General Insurance for various violations related to payments, outsourcing practices, and commission rules found during inspections covering previous financial years. This shows continued regulatory vigilance across different financial services sectors.
And something more positive.
Yes, to end on an inspiring note, the Forbes India W Power 2025 list was released in May. It celebrates self-made women leaders, people like Manu Baker, Leena Nair, Kakuna Kante, who are not only challenging traditional norms in their fields, but also actively building legacies and fostering inclusive leadership across various sectors. It's a great way to highlight the growing strength and impact of female entrepreneurship and leadership in India. Hashtag outro.
Wow, okay. We've just covered an incredible amount of ground today. I mean, from the really nuanced details of market regulations and new financial instruments like SDIs and PTCs.
You have a lot of acronyms.
Right through to the sweeping economic reforms, the big picture growth numbers, and India's growing global stature. It's undeniably clear that things are moving incredibly fast and dynamically across the Indian economic landscape.
Our deep dive has, we really hope, shown you the intricate interconnections between these policy decisions, the fluid market dynamics, and their tangible impact on the economy and ultimately on your daily life.
Yeah.
You see the consistent push for financial market transparency and better risk management from SEBI, the robust health and strategic moves of India's banking sector under the RBI, and this multifaceted growth story unfolding across various sectors: agriculture, renewables, infrastructure. It's all supported by both decisive policy and rapid innovation. These are the powerful threads weaving India's truly dynamic economic fabric right now.
Absolutely. And being informed about these rapid shifts isn't just for financial experts, is it? It's truly crucial for understanding the opportunities and navigating the challenges in India's incredibly dynamic economy, wherever you sit. So, what does this all mean for you, the listener? As India continues its remarkable journey towards becoming a global economic powerhouse driven by both traditional sectors and emerging technologies, how might these deep-seated and foundational changes reshape your investment decisions, maybe influence your career path, or even alter the very products and services you consume in the years to come?
And maybe consider this: as the Indian financial landscape matures and becomes even more interconnected globally through things like Gift City, relaxed FPI norms, potential CPIs, what new, perhaps unforeseen challenges and opportunities will arise from this increased complexity and deeper integration? And how will that delicate balance between robust regulation, which we've seen a lot of, and vibrant innovation continue to evolve to keep pace with these truly rapid and transformative changes? It's a fascinating process to watch.
Keep observing these trends closely, and remember, staying informed is really your best advantage in navigating all this. We hope this deep dive has given you some truly valuable insights and maybe a clearer map of India's economic future as it stands today. Thank you so much for joining us, and we'll be back soon with more fascinating explorations into what truly matters.